Greetings, members one and all of the Salivation Nation. This is an article from Bloomberg, and it gives a little bit of a interesting spin about what controls the price of gold. ETFs. So let's take a look at this article here and delve into what it's talking about and how this can affect us. They're saying here that it is not so much the sentiment that drives a metal's value. Passive products dictate rather than track performance. This is by David Fickling and was written here after the big jump in the price of gold here from the market, of the huge drop in the market price, the Dow Jones Industrial Average. Gold isn't like anything else in the market. Ancient, fundamental, eternal. Is different from all those here today, gone tomorrow assets, such as Snap Inc., shares, and cryptocurrencies, right? Wrong, says the author. Thursday's surge in the spot gold price, a 2.5% jump to $1,224 an ounce, its sharpest leap in more than 2 years, looks like a confirmation of a trend that's been developing for a while. The driver isn't so much time-honored fears about the value of money, but the behavior of exchange-traded funds. And so here we can see a chart talks about the glittering prices, how the jump in the price of gold was its biggest one-day move in more than 2 years. And here you can see the different movements here, and we can see here the movement. If I can zoom in, I don't think it'll let me zoom in, but yeah, you can see a pretty big jump there, over 2%. Pretty amazing, 2.5%. Since hitting a 5-year high in May, ETF holdings of gold have experienced an unrelenting decline, paralleling the slump in the spot metal itself. That didn't really reverse even when the equity market started to slide last week until Wednesday, when the sum suddenly jumped to 259,116 troy ounces. The next day, the price finally climbed too. So here we see the sales season ETF holding of gold surge the week after months of decline. So you can see the declination of the ETF holdings, and then here it's picked back up. The relationship between gold price and ETF holdings is a complicated one, where the biggest question is often which is the tail and which is the dog. I'm going to talk about that later, give you my opinion on it. In the early days of ETFs, when they were seen as products exclusively for retail investors, you'd have expected that the funds followed gold, with the mom-and-pop buyers adding to their exposure whenever the price went up and cutting back when it went down. In fact, over most of the past decade, it's tended to be the other way around, perhaps in keeping with the fact that about a third of ETF investments in the biggest market for the products, the U.S., is now done by institutions. So talking about wagging the dog, raw beta data produced by regression analysis suggests gold is becoming more heavily influenced by ETF demand. ETF holdings here in this chart influenced by spot gold price, and spot price influenced by ETF holdings. And there you go. And looking over the past 10 years, you can see the correlation here. Certainly it does appear the spot gold price influenced by ETF holdings has been the driver for the past 10 years, for sure, according to these charts here. And look, over the last 3 months, it's exploded 1.65%. If you pick ETF holdings as the dependent variable, the one being influenced, and gold as the independent one, a regression analysis of the last 10 years gives you a raw beta of 0.126, suggesting that the metal's price only has a modest positive impact on the amount of buying done by ETF investors. The beta for the opposite case, where ETF holdings are driving the metal price, is consistently stronger than 0.59. That matches the big picture portrayed by demand statistics from the World Gold Council, an industry group. Bar and coin investors, industrial users, and jewelry buyers purchase the yellow metal year in and year out, and central banks have been doing the same thing ever since they gave up in their selling spree in 2009. As a result, ETFs and related funds are the key swing factor in the gold market, driving its slump from 2013 through 2015 when they became net sellers, and helping support its modest revival and turning into buyers in the years since. And it don't mean a thing if it ain't got that swing. So here in this chart, we see the shifts in ETFs between buying and selling gold are the biggest influence in the price now. And we see most of the market action, especially the last 3 months, as we saw up above. So you see jewelry, bar, and coin, ETFs, technology, and central banks. And it's pretty amazing that the jewelry is the dominant market throughout. And it's pretty amazing that, and look how small the central banks acquisitions are in comparison to even bar and coin. Now, the bar and coin sales, I wonder if that includes the central bank holdings. Even as such, even if you consider those, it still doesn't take away from the private acquisition thereof of gold in the form of bar and coins. This is from the World Gold Council. The relationship seems to have intensified as of late. The raw beta when gold is a dependent variable jumped to 1.65 in the past 3 months, suggesting moves in ETF holdings are now having an even bigger influence on the spot metal than usual. And that's quite interesting, because sooner or later I think that's going to come back and bite. And of course we know that ETFs, if these were to actually be exchanged, literally exchanged for gold, there's not enough gold to honor the exchange, and we see that as even worse case in silver. But as I mentioned in prior videos, that's not going to happen. People use this as an alternative way in the stock market game, as an electronic transfer for convenience. They don't want the gold; they want the cash if they need to redeem those electronic transfer funds. In some ways, this doesn't change the old argument for investing in gold, which is most important. Beta isn't related to ETF holdings, but to stock market returns. When fear rises and the value of your equity portfolio falls, the yellow metal still has a mild tendency to climb and offset the losses elsewhere. Still, those who look to gold as a refuge from the madness of crowds shouldn't get ahead of themselves. These days, the crowds are in the driver's seat. Well, and again, and it's talking about the tail wagging the dog and the like. But really, if you think about it, even though they're saying the ETFs are the driver, and this data here seems to support that, without gold, it would be nothing. There's got to be the physical to at least represent it. And that's why you and I, we stack the physical. And some of you may actually have in your portfolios, as a matter of convenience, the ETFs as well. And there's nothing wrong with that. But understand that really in the end, it's wise to accumulate some physical as well. And I understand there's a lot of people even that watch this channel who do dabble in the markets, and that's fine. And I'm not even suggesting getting out of them, because there's been some great returns in the markets. But when it's all said and done, the best preserver of wealth is gold and silver. And I do believe that if you are in the markets, more than likely for watching this channel and this video, you do have physical as well. And I believe that gold is money. I believe that silver is money. And I think that's what makes them so unique, and in holding them. Though they're not used as currency right now, that does not discount the fact that they are both money. And so holding on to them, I think, is a wise move. And no matter what, no matter how big this gap is between ETF holdings influenced by spot gold price and spot gold price influenced by ETF holdings, because in the end, it's all the same. It's a counterweight. Gold and silver are counterweights to to economic conditions or instability. And those counterweights, we like to increase our holdings of those weights to increase our stack and our position of the ultimate way to preserve wealth, gold and silver. So post your thoughts below. I'd like to extend a multitude of gratitude to y'all for watching and encourage you to please rate, comment, and subscribe.